classmates. Welcome to International Microeconomics. Today, we will begin to learn Chapter 5, National and International Accounts, Income, Wealth, and the Balance of Payments. The goals of this chapter are to explain the international system of trade and payments, to discover how international trade in goods and services is complemented and balanced by a parallel trade in assets, and to see how this transaction relate to national income and wealth. There are 5 sections in this chapter. Section 1, Measuring Macroeconomic Activity, an overview. Section 2, Income, Product, and Expenditure. Section 3, the Balance of Payments 1. Section 4, the Balance of Payments 2. Section 5, External Wealth. Today, we will discuss Section 1, Measuring Macroeconomic Activity, an overview. To understand macroeconomic accounting in an open economy, we build on the principles used to track payments in a closed economy. So we first look at the flow of payments in a closed economy. Figure 1 shows how payments flow in a closed economy. We can start to follow the flow at the top with gross national expenditure, GNE, the total expenditure on final goods and services by home, consumers, business, and government in any given period. When GNE is spent, where do the payments flow next? The spending counted in GNE constitutes all payments for final goods and services within the nation's borders. Because the economy is closed, the nation's expenditure must be spent on the final goods and services produced within the same nation. A country's gross domestic product, GDP, is the value of all intermediate and final goods and services produced as output by home firms, minus the value of all intermediate goods and services purchased as inputs by home firms. In a closed economy, intermediate sales must equal intermediate purchase. So in GDP, these two terms cancel out, leaving only the value of final goods and services produced, which equals the expenditure on final goods and services, or GNE. Thus, GDP equals GNE. When GDP is sold, where do the payments flow next? GDP measures the value of firm outputs sold minus the cost of firm imports bought. This remaining flow, equal to sales minus costs, is left over to be paid by firms as income to the factors of production employed by the firms. The factor owners receiving this income are the owners of labor, the owners of capital, and the owners of land. So in a closed economy, all income is paid to domestic entities. The total income of an economy is gross national income, GNI. Once GNI is received by factors, where do the payments flow next? Clearly, there is no way for a closed economy to finance expenditure except out of its own income. So total income is in turn spent and must be the same as total expenditure. This is shown by the loop that flows back to the top of Figure 1. In a closed economy, expenditure is the same as product, which is the same as income. But when a nation opens itself to trade with other nations, however, the flow becomes a good deal more complicated. Figure 2 incorporates all of the extra payment flows to and from the rest of the world, which are recorded in a nation's balance of payments, BOP accounts. The circulating purple arrows on the left side of this figure resemble those in the closed economy case seen in Figure 1. These arrows flow within the purple box, which represents the home country, and do not cross the edge of that box, which represents the international border. The cross-border flows that occur in an open economy are represented by green arrows. There are 5 key points on the figure where these flows appear. We also start at the top with the home economy's gross national expenditure (GNE). In an open economy, some home expenditure is used to purchase foreign final goods and services. At point 1, these imports are subtracted from home GNE because those goods are not sold by domestic firms and are not part of home GDP. In addition, some foreign expenditure is used to purchase final goods and services from home. These exports must be added to home GNE because those goods are sold by domestic firms and are part of home GDP. The difference between payments made for imports and payments received for exports is called the trade balance (TB), and it equals net payments for domestic firms due to trade. GNE plus TB equals GDP, the total value of production in the home economy. At point 2, some home GDP is paid to foreign entities for factor service imports. That is domestic payments to capital, labor, and land owned by foreign entities. Note that this income is not paid to factors at home, so it's subtracted when computing home income because it's not part of home GNI. Similarly, some foreign GDP may be paid to domestic entities as payment for factor service exports. That is foreign payments to capital, labor, and land owed by domestic entities. Note that this income is paid to factors at home, so it's added when computing home income because it's part of home GNI. The value of factor service exports minus factor service imports is known as net factor income from abroad, NFIA. Thus, GDP plus NFIA equals GNI, the total income earned by domestic entities from all sources, domestic and foreign. At point 3, we see that the home country may not retain all of its earned income, GNI. Why? Domestic entities might give some of it away, for example, as foreign aid or remittance by migrants to their families back home. Similarly, domestic entities might receive gifts from abroad. Such gifts may take the form of income transfers or may be in-kind transfers of goods and services. They are considered non-market transactions and are referred to as unilateral transfers. Net unilateral transfers (NUT) equals the value of unilateral transfers the country receives from the rest of the world minus those it gives to the rest of the world. These net transfers are added to GNI to calculate gross national disposal income (GNDI). Thus, GNI plus NUT equals GNDI, which represents the total income resources available to the home country. The balance of payments accounts correct together the trade balance, net factor income from abroad, and the net unilateral transfers, and report their sum as the current account, an important tally of all international transactions in goods, services, and income that occurs through market transactions or transfers. The current account is not, however, a complete picture of international transactions. Resource flows of goods, services, and income are not the only items that flow between open economies. Financial assets, such as stocks, bonds, or real estate, are also traded across international borders. At point 4, we see that a country's capacity to spend is not restricted to be equal to its GNDI, but instead can be increased or decreased by the export or import of assets to or from other countries. When foreign entities acquire assets from home entities, the value of these asset exports increase resources available for spending at home. Conversely, when domestic entities acquire assets from the rest of the world, the value of the asset imports decreases resources available for spending at home. The value of asset exports minus asset imports is called the financial account FA. These net asset exports are added to home GNDI when calculate the total resources available for expenditure in the home country. Finally, at point 5, we see that a country may not only buy and sell assets, but also give or receive transfers of assets as gifts. Such asset transfers are measured by the capital account KA, which is the value of capital transfers from the rest of the world to home minus those from home to the rest of the world. These net asset transfers are also added to home GNDI when calculating the total resources available for expenditure in the home country. At last, we have arrived at the bottom of Figure 2, and we have finally computed the total value of all the resources available to use for home spending, which is gross national expenditure, GNE. We start at the top with GNE. We add the trade balance to get GDP. We add net factor income from abroad to get GNI. And then we add net unilateral transfers received to get GNDI. We then add net asset exports measured by the financial account FA and net capital transfers measured by the capital account KA, and we get back to GNE. That is, we start with GNE, add in everything in the balance of payments accounts, and still end up with GNE. What does this tell us? The sum of all these items in the balance of payments account, the net sum of all those cross-border flows, must add up to 0. That means that the balance of payments account must balance. We explore in more detail the implications of this insight later in this chapter. That's all for today. See you next time.